You are listening to the Objects of Affection collection. Study 46. The Bag-Backed Security, How the LUXUS Fund Signals the Death of Old Luxury and the Rise of the Post-Luxury Era. The 21st century has borne witness to a silent, seismic shift in the semiotics of value. Luxury, once the bastion of craftsmanship, heritage and ineffable savoir-faire, has been systematically hollowed out, its cultural meaning evacuated and replaced by a new, cold and relentlessly quantitative logic. The alternative asset has supplanted the object of affection. This transformation was not an accident. It was a deliberate, institutional project to financialize desire, to codify taste, and to render the intangible liquid. What was once a Veblen good, whose value was derived from its conspicuous consumption and social sign value, has been formally repositioned as a securitizable asset class, indistinguishable in its portfolio function from real estate, private equity, or gold. This shift is no longer a niche theory, but a dominant strategy for the world's financial elite. The 2024 Knight Frank Wealth Report, a key bellwether for ultra-high net worth individuals, UNWI, revealed that a staggering 70% of this cohort had increased their allocation to luxury investments over the preceding year. A newfound appreciation for artisanship does not drive this capital migration. It is propelled by a search for strong returns, and crucially, for assets that are uncorrelated with the volatility of traditional financial markets. The central thesis, articulated by wealth managers and alternative investment platforms, is that tangible assets like art, diamonds, and high-end handbags often retain or even increase in value during economic downturns. This financialization has created an entire ecosystem of analysis, replete with its own indices, reports, and academic justifications. The performance of luxury categories is now charted with the same rigor as stocks and bonds, with reports from firms like Splintinvest and Fascionica dutifully comparing the 5-year appreciation of a Chanel classic flat bag against the S&P 500, or the monthly volatility of a Rolex against the Stoxx 50. This is not a mere comparison, it is a redefinition. It subsumes the object entirely into the language of finance, where its only legible qualities are its growth rate and its risk profile. This perspective has deep roots in academia, which has long provided the intellectual framework for this detachment. A 2004 paper in the Journal of Finance titled Luxury Goods and the Equity Premium did not analyze luxury for its cultural import, but instead used novel data on the consumption of luxury goods as an econometric tool to analyze the risk aversion and portfolio choice behavior of the wealthy. For the financial world, luxury items are not objects but data points that illuminate market behavior. This same logic now dominates the corporate boardroom. The strategy of building the balance sheet in the fashion and luxury goods industry is a formal priority, with private capital flowing into the sector not just to sell products, but because luxury brands themselves are seen as a solid long-term investment. Firms are now advised to leverage the intangible value of their brands and intellectual property as innovative financing options. Yet this entire financial edifice is built on a foundational myth. The relentless marketing of luxury as a stable, appreciating asset class masks a deeply contradictory and volatile reality. The passion investing narrative is precisely that, a narrative. While platforms like Convi, which sells fractional shares in Birkins, boldly claim the bags have never fluctuated downwards in value, the industry's own data refutes this claim entirely. The very same 2024 Knight Frank report that trumpeted UNWI interest also showed that, as an asset, handbags had lost value, posting a -4% return. A 2025 study by Fascionica found that over 5 years, low-good pieces like the Chanel classic flat bag underperformed the S&P 500. Furthermore, a 2024 analysis of the luxury watch market revealed a decline of nearly 8%, in stark contrast to the growth of traditional indices like the SMI and Stoxx 50. This reveals the first and most profound detachment. The primary product being sold is not the asset's consistent performance, but the myth of its performance. 70% of UNWI are not buying handbags, they are buying a story about stability in a time of uncertainty. The financialization of luxury is therefore the financialization of a feeling. The object is merely the collateral for a narrative. This critical separation, between the financial story being told and the object's actual volatile market behavior, created fertile ground for the ultimate abstraction, a system in which the object itself would no longer be necessary at all. The engine of abstraction, fractionalization and the democratization of scarcity if the idea of luxury as an asset was the ideological spark. Then fractionalization is the technological engine that enables its total dematerialization. This is the mechanism that liberates the object's financial value by, quite literally, imprisoning the object itself. The fractional ownership model is the key driver of this new market, which is projected to grow at a 15% compound annual rate. Once confined to high-value illiquid assets like private jets and real estate, this model is now expanding aggressively into fine art and collectibles. The core innovations that enable this abstraction are blockchain and tokenization. This technology performs a kind of financial alchemy. It takes a singular physical object, a Picasso, a Patek Philippe, or a Hermes Birkin, and digitally divides it into thousands of digital tokens. Each token, stored on a secure blockchain ledger, represents a legal share of ownership. The stated benefits of this process are, without exception, purely financial. They speak not of aesthetics, craft, or history, but of increased liquidity, lower costs, transparency, and global access. This model, proponents claim, democratizes the formerly exclusive world of luxury investing. This democratization is marketed heavily to a new generation of investors, particularly Gen Z and millennials, who are invited to participate in a market previously reserved for the ultra-wealthy. Platforms like Limpid, for instance, allow an investor to own a share in an appreciating luxury handbag for as little as €30. This rhetoric of access and inclusivity masks a profound, paradoxical inversion of values. The traditional concept of luxury, as hollow as it became, was still predicated on use. Its sign value was generated through public display, through the wearing of the watch or the carrying of the bag. The fractional model annihilates this. What precisely does the €30 investor on Limpid actually own? They cannot see the bag, they cannot touch the bag, and most critically, they cannot wear the bag. The physical object, in fact, is a liability to its new financial purpose. To ensure the asset's value is not compromised by the friction of reality, a scratch, a stain, a single sign of wear, it must be removed from the world. As Limpid's own materials state, all handbags in our investment portfolio are stored in a secure, insured and climate-controlled environment in a bank vault. Another platform, More Luxury Club, boasts of removing the hassles out of ownership, which it defines as insurance, cleaning, maintenance, repair, storage and logistics. The hassle to be eliminated, it turns out, is the entire human experience of using the object. This is the central paradox of fractionalization. It achieves mass access to an object's financial value by ensuring mass alienation from the object's physical function. The platform does not sell fractional ownership of a handbag, it sells fractional ownership of a ticker symbol that is collateralized by a vaulted handbag. The technology democratizes the financial abstraction, not the luxury object. The object has been fully dematerialized. Its use value has been reduced to a risk that must be neutralized in a bank vault. The only use left is its 24/7 liquidity, a quality that is the very antithesis of a physical, tangible artifact. This is the second great detachment, paving the way for the final hyperreal collapse. Case study: LUXUS and the 43-day flip. This total abstraction from the physical object finds its purest expression in the emergence of LUXUS. This entity is not a collector, a reseller, or a fashion house. It is, by its own definition, luxury alternative asset management. Its stated mission is not to celebrate craft, but to pursue the curation, securitization, and monetization of the world's scarcest luxury assets. This is the explicit, undisguised language of high finance, representing the final stage of the hollowing out process. LUXUS is not the democratized retail-level fractionalization of a Limpid or a Convi. It has escalated the game, targeting its investment opportunities exclusively to accredited investors. This moves the luxury object out of the realm of mere collecting and into the world of quasi-institutional high finance. The operation is given a crucial veneer of old luxury legitimacy through its most significant partner. LUXUS is backed by Christie's. This partnership is a masterstroke of semiotic laundering. Christie's, the venerable auction house, has itself spent the last decade meticulously repositioning high-end handbags away from fashion and toward investment-grade objects d'art. By backing LUXUS, Christie's provides the institutional validation and, more importantly, the liquid high-consensus resale channel that this new financial model demands. The definitive proof of this model, the smoking gun of total financialization, is the performance of its first fund. The Micro-LIAF, Hermes Edition 01, a $1 million fund, returned 34% in 43 days. This single data point is the obituary for old luxury. Let us be clear, this is not an investment. Investment, even in the context of passion assets, implies a long-term horizon, a stewardship that allows an object's value to mature and appreciate over years, if not generations. A 43-day holding period is the temporal logic of a high-frequency trader. A 34% return in that window is not appreciation. It is a speculative trade based on market arbitrage. This model does not care about the bag's history, its leather, or the hands that stitched it. It requires only two things: high-volume price volatility and a hyperliquid resale market. This is the bag-backed security made manifest. The term is a direct analogue to the asset-backed securities (ABS) that populate modern financial markets. An ABS is a financial instrument collateralized by an underlying pool of assets that are valued for their predictable cash flow. In the LUXUS model, the asset pool comprises a curated selection of Hermes Birkin and Kelly bags. Their cash flow is the volatility of their resale prices. The fund, therefore, is not investing in handbags. It is trading the rapid, predictable fluctuations in their resale value. The bag itself has become entirely irrelevant. It is a commodity chip in a high-stakes casino, a physical token whose sole purpose is to serve as collateral for a bet on its own price movement. The LUXUS model is the logical endpoint of the process. It is not selling bags, it is selling shares in the resale price of the bag. This is the total, final collapse of the object into a pure financial abstraction, an event so significant that it requires a more robust theoretical diagnosis. The simulacrum made real, a Baudrillardian diagnosis. This phenomenon, this total dematerialization of the object into a pure financial instrument, is the simulacrum of luxury, made real. It is the logical and inevitable endpoint of a cultural trajectory described decades ago by the French critical theorist Jean Baudrillard. To understand the LUXUS fund is to understand Baudrillard's procession of simulacra. Baudrillard argued that in a consumer society, commodities are valued less for their use value, their function, or their exchange value, their monetary cost, and increasingly for their sign value. Sign value is the meaning an object conveys, the style, prestige, luxury, or power it signifies. Old luxury was from its inception a system of signs, a self-referential system of coded signs in which value was determined by a brand's ability to construct symbolic hegemony, e.g., Chanel's quilting Hermes orange. Baudrillard mapped the journey of the sign through 4 stages, a procession that moves from a reflection of reality to a total detachment from it. The first stage: the image is a faithful copy, a reflection of a profound reality. It is a good, true appearance, a symbol that accurately represents a real thing. The second stage: the image is an unfaithful copy or counterfeit. It masks and denatures a profound reality. It is an evil appearance, a sign that lies about the real. The third stage: the image is a simulacrum. It masks the absence of a profound reality. The sign no longer points to a real thing, it only points to other signs, pretending a reality exists where there is none. The fourth stage: the image is a pure simulacrum. It is the hyperreal. It is a copy without an original that bears no relation to any reality whatsoever. The simulation precedes and generates the real. Financial markets themselves have been analyzed as a pure simulacrum, a system in which money, unfettered from its original role as a symbol of an underlying thing of value, like gold, has taken on a reality of its own. The LUXUS fund is the crash point where the simulacrum of finance and the simulacrum of luxury merge into one. The Hermes Birkin bag is the perfect object to trace this tragic 4-stage trajectory. Stage 1, the original reflection of reality. The original Birkin, famously sketched on an Air France flight for Jane Birkin, was a reflection of a profound reality. It was designed to solve a real problem, a need for a functional, elegant, durable, and spacious travel bag for a new mother. Its value was rooted in its use. Stage 2, the sign masking reality. This is the old luxury Birkin of the 1990s and 2000s, the era of the infamous wait list. This bag masked and denatured its original reality. Its function as a bag became secondary to its new function as a sign of elite status. Its value was no longer in its utility, but in its sign value, its ability to signify that its owner had the wealth, patience, and connections to acquire one. Stage 3, the resale market masking the absence of reality. This is the Christie's era Birkin, the investment-grade object d'art. This object masks the absence of a profound reality. Its auction price $165,100 for a Faubourg Birkin 20 has no connection to its material cost, its craft, or even its sign value as a status symbol. Its value is determined by its resale price. It is a simulacrum of the sign, an asset whose value is determined solely by its performance in the secondary market. It has become a self-referential financial loop. Stage 4, the LUXUS fund, the hyperreal. This is the bag-backed security. It is the pure simulacrum. The LUXUS fund is not selling the bag, Stage 1, the sign, Stage 2, or even the asset, Stage 3. It is selling a financial derivative of the asset, a share of the resale price, Stage 3, which was a simulacrum, Stage 2, of an original object, Stage 1. This is the copy without an original. The 43-day, 34% return is hyperreality in its most terrifying form, a financial event so rapid and so detached that it precedes the object's physical existence. The real bag, locked in a vault, is just a ghost validating a transaction that occurs entirely in the realm of financial simulation. This is the simulacrum of luxury made real. A crisis of value, the objects that break the model. The total financialization represented by the LUXUS model is not merely a new chapter in the history of luxury. It is a crisis of value. The model is not just a platform for trading. It is an ideological filter that redefines value in its own image. A bag-backed security can only function if the bag is as legible, interchangeable, and fungible as a barrel of crude oil or a share of blue-chip stock. This system requires global consensus on an object's worth, based on nothing but brand recognition and resale price. This is a value monoculture. It can process only one attribute, tradable consensus. By doing so, it actively erases all other forms of value. It cannot see or quantify the human story, craft, and connection that give an object true, lasting meaning. This is the cultural crisis that the financialization model has created, and it is the intellectual and commercial vacuum that our framework, post-luxury conceptual functional art, is designed to fill. The post-luxury conceptual functional art framework is the direct antidote to the bag-backed security. It is not to create products for market, but to forge artifacts for life. It champions the unsmooth object, which is defined not by its liquidity, but by its narrative, imperfection, and haptic resistance. Where the financial model demands an alienable commodity that can be flipped in 43 days, the post-luxury conceptual functional art framework seeks the inalienable possession, an object so embedded with narrative and meaning that it becomes priceless, the very antithesis of a liquid asset. The remainder of this study continues at objectsofaffectioncollection.com. This has been a study from the Objects of Affection Collection, a critical art research institution operating under the framework of post-luxury conceptual functional art. Read the full research at objectsofaffectioncollection.com.